I want to start by getting a show of hands. I'm curious to know who in the audience has heard of the term alternative data as it relates to capital markets. Quandlers, do not put your hands up. You will skew the results. Okay. Here's my flicker. Okay, so not a lot of hands, which is not surprising given that it's early days for this category. It's been around for about a year and a half. So tonight I'm going to talk about alternative data and why it matters so much to capital markets. So as most of you know, what all active investors seek to do is to beat the market. And in the financial services industry, this is known as capturing alpha. And the really important thing that you need to know about alpha is that it is a zero-sum game. So for the profits earned by a winner, they will always be offset by the losses sustained by a loser. So not everybody can win in this game. And that means that markets are extremely competitive. Investors are constantly looking for an edge, a source of advantage that they have that no one else has. This has been the case really since the dawn of investing, and I just want to go through a couple of quick examples with you. In 1865, a group of traders orchestrated a scheme where they had French actors visit the Chicago Board of Trade to ask about acquiring a winter's worth of wheat for the army of Napoleon III. Speculators rushed to buy wheat futures. And of course, Napoleon's so-called emissaries disappeared within hours, leaving the speculators high and dry and creating vast profits for the organizers of the scheme. This was known as manufacturing information, and it was a source of alpha. In the 50s and 60s, a man named Alfred Winslow Jones figured out that he could beat the market by pitting the stocks in his portfolio against one another. He would long one and short the other. Today, this sounds very basic, but at the time, this flew in the face of conventional wisdom, which was all about market timing and only looking at macro factors. So Jones and his contemporaries would enjoy this edge. This notion of hedging stocks against one another gave birth to the hedge fund, and Jones and his contemporaries would enjoy this edge for more than a decade before other people caught on to it. Today, the things that Jones figured out are taught in Finance 101 classes. There is no edge to be had there anymore. In the 1980s, the scientific calculator still reigned supreme, and investors used it to price bonds one at a time. The advent of computers meant that we could now perform hundreds of these calculations per second, which offered a speed advantage, if only for a short period of time. So you can see that these sources of alpha, they come from different places. They could arise from new technology. They could arise from new investment models. They can also arise from information. This happened too. When you think about fundamental analysis and fixed income research. In the 1970s, a small company at the time called Reuters started piecing together faxes of financial statements that they had captured from annual reports. And this was a source of alpha. And really all it was early fundamental analysis. In 1982, Bloomberg launched its terminal, and they had fixed income prices that nobody else had. Same deal. Today, we think of fundamental analysis and fixed income prices as table stakes. Everyone has to have them, or they're at a disadvantage. But nobody gets an advantage just by having them. I'm going to check my notes here. So there's always an edge to be found, but if it is a real edge, it will eventually diffuse so completely that it provides an advantage to no one. However, by the time that happens, everyone has to have it. Today's edge is again from information, and increasingly that information comes from what we call alternative data. Alternative data is information that has not previously been used in the capital markets industry, but is nonetheless very, very valuable to investors. It always arises from sources well outside of what we traditionally think of as financial market data. Here's an example. When you buy a book from Amazon, who knows about that purchase? You know about that purchase, Amazon knows about it, your credit card company knows about it, The GPS unit in the truck that delivers the book knows about it. The satellites watching the GPS unit know about it. Even the security camera in your condominium's lobby probably knows about it. So there are a lot of sources out there that can tell us about this particular purchase. This data is hard to access, but if you can get it, you can paint a bottom-up, granular, near real-time view of an Amazon transaction. Now imagine doing this across millions of transactions. That is the promise of alternative data. So why now? Because we have seen the dawn of the data economy. In May of this year, The Economist referred to data as the world's most valuable resource and the fuel of the future. The technology boom of the 90s, along with Moore's Law improvements in processing power and storage, plus our outrageous need to measure everything, has produced a world in which virtually everything can be measured. The prevailing belief is that there are predictive signals buried in the exabytes of data that we're creating, and these signals have the power to move markets. So it's on us now to find them. Put it all together, and we're entering a new age of alternative data. The sheer scope of data available, plus the history of data innovation, have combined to produce an industry that is going to see massive returns in the coming years. And people are ravenous for it. The early adopters of alternative data are quantitative hedge funds, but just like all other sources of alpha, we believe this trend will be pervasive across all capital markets, all forms of investing, all asset classes globally. So now I want to talk a little bit about what Quandl's role is in all of this. Quandl's a marketplace for alternative and financial data. We're an online marketplace just like many other marketplaces you know about. The difference is we don't sell a product or a service, we sell data. We didn't start out by selling data. We started the way most startups do back in 2012 when our founders, Tamer Kamel and Abraham Thomas, needed to solve a problem in their previous lives as hedge fund professionals, that there was no good way to consume the myriad amounts of financial data they needed for their trading strategies. So they set out to solve that problem, and the first iteration of Quandl did just that. Fast forward a few years, in April of last year, Tamer and I were at a conference in New York called the Battle of the Quants, and he said to me, you know, I really think, Carrie, I really think we need to get some alternative data onto the platform. And I said, what's alternative data? And so he explained it to me like I explained it to you, and I said, gee, that kind of sounds like a pivot. Can I think about it? Can we talk about this next week? And he said, no, we can talk about this right now. So Tamer, once he saw the trend, he realized that we needed to move on it very quickly, and sure enough, we came back to Toronto. We rejigged the Quandl marketplace to support the incorporation of alternative data on the platform. And it turns out it wasn't so much of a pivot as it was an evolution to what we were already doing. And it was a very lucrative one. In the first quarter that we had alternative data for sale on the platform, our revenues increased by 900%, and they're still going. But it's not always easy to find it. One of the big challenges with finding data supply, beyond the fact that there's just so much of it and you have to know where to start, is that there are many steps to determine whether it is going to be saleable or not. There's a lot of data out there that might say something about Amazon or Alibaba or Exxon or any other security that you can think of. But if it doesn't say it faster or better than what's already available, it's going to be of no value. And so that's why the data needs to be a leading indicator, not a coincident or a lagging one. In another example, you could have data that's really highly correlated with some type of security, but the correlation makes no logical sense. I've always enjoyed this example. You can't see it on the screen, there we go. That the divorce rate in Maine happens to be very, very highly correlated with the amount of margarine consumed. But there's absolutely no logic to that whatsoever, so it's kind of a useless thing to know. There's about 100 other ways a data set can go wrong. And we estimate that for every 10 data sets we assess to put on the Quandl platform, only one actually makes it through. So there's a real challenge in sourcing supply. At Quandl, we employ a team of data scientists whose sole purpose it is to be out there hunting for and evaluating the best on offer from the data economy. And the size of our data science team actually rivals the size of our development team, which shows you how much of an investment we put into the data itself. Even if you get to the point where you have a saleable asset, you still need to make this data consumable by a Wall Street audience. You can't just flip a CSV file over to a hedge fund and be done with it, because that's not the way they work and that's not the way they want to work. You have to make your data, you have to harmonize your data, you have to make it available via API. We support other modules that financial services people like to use, like Python and R. Investors, especially quantitative investors, typically don't want to consume pure raw data, so you have to package it up as an index for the quantitatively minded and level it up with some analytics for the qualitatively minded. So to that end, Quandl offers data in a manner designed for quantitative investors at the moment, most often consumed via API, and we're now working on an offering that will service the broader discretionary side along with the sell side that will be more analytics driven. So I'm going to finish off just by looking at the different types of alternative data and then 2 very quick case studies. So we divide alternative data into 3 generations. The first generation contains data you've probably heard of, sentiment data like data from Twitter, data from the news. The thing about sentiment data is it's the oldest form of alternative data, and in fact it predates the term, but most people believe it's been priced into the market already, so there's no advantage to be had there anymore. In the second generation of data, which is where we really are right now, there's a lot of what we call business exhaust data, which is data that is a byproduct of what is already being done for a business's operations. And I'm going to give you an example from the insurance industry in a minute. And it sounds excruciatingly boring, but it probably has the most potential for alpha out of any of the data sets out there. Logistics and supply chain is very exciting too. And the third generation is where you hear all the fun stories about drones taking pictures of agricultural crops, but that's really just fodder for the media right now, and people aren't actually using that in the institutional investing world just yet, but we're still keeping an eye on that. Quick case study, Tesla. Tesla's been in the news a lot lately. Why? Because they have to vastly ramp up their production in order to support the demand for the Model 3. Quandl has a data set that is created from several US insurance providers who give us a daily count of the number of policies that they've written for new cars. I'll just do the one case study and then I'll finish up. Okay. This is an extremely powerful way to approximate new car sales, because when you buy a new car, the first thing you do is you buy insurance for it. So for somebody holding a position in Tesla, we can tell them on a daily basis whether Tesla is making good on their promise to deliver these Model 3s by looking at the policies that they're issuing. That's a very powerful data set and one that does very well. We've got one for GoPro too, but unfortunately I'm out of time. So I'm just going to finish up by saying we find ourselves in the precarious, very startup-y position of being early in the hype cycle. While it's early days for the adoption of some of these more esoteric data sets, the competition is really, really heating up. And this is what keeps me up at night. How do we sustain our advantage here? And I think the answer really boils down to 2 things. We hire the best people, and we find the best data. So if any of you in the audience are either of those, there's a lot of Quandlers here tonight, and we would welcome the opportunity to chat with you. Thank you.
Questions?
Thanks for your presentation. It was great. How do you think the companies that are being covered by some of these sources of data are going to start changing their behaviors abnormally to try and trick it? So I don't know if you've seen the show Billions. It's about a hedge fund guy, uses all kinds of data. And in the show, he finds out that Amazon starts changing its trucking pattern on purpose to change his satellites because they were trying to use it. So do you think that's going to be some weird behavior, like Tesla buying extra insurance that they don't need to trick data like this to shoot up their stock price?
I think it's a fantastic question. I gotta say, I doubt that's gonna happen. I really doubt it. I don't think they're gonna change their behavior, and I think if you look at that cycle of diffusion that we were talking about before, eventually this information is gonna get priced into the market, and even if there is a little bit of time there where they may try to change things in an effort to do that, over time they'll just go back to the status quo.
And what kind of data are you most excited to see on the platform, like that's not there right now that you would love to see in 2 years or something?
Well, you know, personally, I think there's a lot of opportunity with drone and satellite data that's yet to be realized. But there's huge challenges with it, especially with drones and privacy, right? And we want to respect that privacy. But it's just so freaking cool what you can do with those images these days and the kind of analysis you can do on them. So just from a pure technology perspective, it's really interesting to me.
Great, thank you.
Hi, great presentation.
Thank you.
So actually I went through one of these like Finance 101 courses, and the first thing we learned is that in a North American cycle, it's very rare for individual stocks to really beat like stock indexes because it's efficient markets.
Yeah.
And that's one of the reasons why I didn't invest in stocks and I invested in ETFs because there's not really much of an edge.
Right.
So I understand you're very early stage. So do you guys have any data on how this alternative data provides you an edge, in an effect helping you beat the stock market?
That's a great question. That is an excellent question. So first of all, I am never, ever, ever going to give anybody investment advice. So let me just get that caveat out there. Second of all, the way that our clients use our data, we will never know, right? So the majority of our clients are quantitatively focused hedge funds right now. They put our data into their trading strategies. They do not say a word to us about how they're doing that, and they never will. However, that being said, our data science team performs a lot of back testing on the data sets that we have, and in fact, that is one of the criteria we look at before we decide whether to include a particular data set on the platform. So with that insurance data, for example, we did a back test where we took a 10-day position on, we took 10-day short and long positions on the stocks that seemed to do the best and worst according to the data set, and we discovered that it worked, and it was a little less than 1% better. So we do that kind of research all the time. That's not to say it can be easily replicated, though. Does that answer your question?
That does. Thank you.
Hi there. Great presentation. Big fan of what you guys are doing. Recently, or at least assessing crypto markets, it seems that it basically goes up and down based on market sentiment. Do you guys currently have an offering in that area? If so, how would you assess something like that?
I don't believe we have an offering in crypto markets. Sorry.
That's okay.
Can't help you there.
All right. I think that's it. Thanks, Carrie.